All right, let's get right to it. We're going to tackle one of the absolute toughest questions for any investor. And it's not what you think. It's not about picking the next big winner. It's about what you do when it feels like everything is falling apart.
Actually picture this. Half your life's savings. Just gone. Vanished. The news is all doom and gloom, screaming about a crash. And every fiber of your being is telling you to just sell. Get out. Stop the bleeding. So, what do? I'm not kidding when I say your answer to that question, well, it could define your whole financial future.
And that's where a legend comes in, the one and only Charlie Munger, Warren Buffett's right-hand man for decades. And let me tell you, Munger, he never pulled any punches. He basically said that how you handle a massive, gut-wrenching drop, that's it. That's the real test. That's what separates the pros from the amateurs.
Yeah, he saw it as this trial by fire. If you want to build real, lasting wealth in the market, you have to go through it. So for our purposes, let's call it what it is, the 50% drop test. So here's the core idea, right? Munger's whole point was that these huge, terrifying market drops, they're not a maybe, they're a when. It's gonna happen. Think of it like the price of admission. You want to get the great returns the stock market can offer? You got to pay the price, and that price is enduring the panic. Your ability to just hold on, to not freak out. That's the whole game. Okay, so listening to me talk about it here, it probably sounds pretty simple, right? Just don't panic. Easy. But in the real world, when it's your money on the line, most people fail this test. They fail it spectacularly, and we really need to dig into why. The first thing you have to get into your head is that the market going up and down like a roller coaster, that's not something broken. That's just how it works. It's part of the deal. And I mean, even the absolute titans of industry, the best of the best, they get hammered sometimes. Let's look at a few names you'll definitely know. So let's start with the ultimate example, Berkshire Hathaway, Munger and Buffett's own baby. I mean, if any company is a fortress of stability, it's got to be this one, right? Surely it's immune to this kind of craziness. Wrong. Not even close. Back in the big financial crisis of 08-09, Berkshire Hathaway itself got cut in half. Its stock price lost more than 50% of its value. Think about that. The greatest investors of our time watched their own ship get torpedoed just like everyone else.
All right, what about a newer giant? A company that literally changed the world, changed how we buy everything.
Yep, you know who I'm talking about. Even Amazon. A world-changing force. It's had periods where its stock just got completely annihilated. Drops of way more than 50%. It's not a one-time thing. Okay, one more, just to really hammer this point home. Let's take what is, at any given time, one of the most valuable, most loved companies on the entire planet. And it's the same story. Even Apple, the company that put a smartphone in everyone's pocket. It's had times where the stock was just sliced in half. So the lesson here, I mean, you can't argue with it. So you see, the problem isn't that these amazing companies had bad periods. That's normal. The real failure, it's us. It's human nature. It's that gut reaction to hit the sell button when you're terrified. And the second you do that, you've taken a temporary drop on your computer screen and turned it into a very real, permanent loss in your bank account. And you almost guarantee you're going to miss the rebound.
All right, so we know the storm is coming eventually, and we know why most people's boats sink when it hits. So the big question is, how do you build a boat that can weather it? How do we actually prepare to pass this test?
Yeah, there's a financial planner, Taylor Kovar, who puts it so well. He basically says what Munger said. You can't avoid the pain. It's not about being fearless, it's about being prepared. It's about having a plan before the pain hits. And his advice boils down to three really smart things. First, diversify. Don't put all your eggs in one basket. That way, if one investment goes bad, it doesn't wreck your whole portfolio. Second, and this is huge, have cash ready. Liquid cash. That's your safety net, so you aren't never, ever forced to sell your stocks when they're down just to pay a bill. And third, and this is the absolute key, make your plan now. Make it while you're calm, cool, and collected, not in the middle of a 5-alarm fire.
This really gets to the heart of it, doesn't it? When a stock you own plummets, there are two ways to think. The panicky, emotional brain screams, the price is falling, get out. But the disciplined, rational brain asks a totally different question. Wait a second, is the company itself still good? Has anything actually changed about its long-term prospects? Because if the answer is no, then a lower price isn't a fire alarm, it's a sale. And this brings up a really interesting kind of backwards idea. Because so many people are terrified of these drops, they just run for cover. They look for what they think is safe. But what they don't realize is that safety has a cost, a very big hidden cost. Just look at this chart. It tells the whole story. You stick your money in a safe savings account, and over the long haul, inflation just eats it alive. You're actually losing buying power every single year. You're safely getting poorer. But stocks, with all their wild swings, have historically been one of the only things to actually beat inflation by a long shot. And boom, we're right back to what Charlie Munger was talking about. You can't handle the heat, so you get out of the kitchen. You put your money where it feels cozy and safe, and you lock in that mediocre result he warned you about. You're essentially trading away real long-term growth for a feeling of safety that isn't even real.
So, when you boil it all down, passing this 50% drop test, it's not really about spreadsheets and stock picks. It's a mind game. It's about psychology. It's about deliberately building a mindset that can handle the pressure.
So you've got to ask yourself, which path are you on? Are you going to be the emotional investor, just reacting to every scary headline, buying high and selling low? Or are you going to be the disciplined wealth builder, the person who gets it, who understands the chaos is just the price you pay for admission, and who calmly sticks to the plan?
Look, Munger's rule isn't some hot stock tip. It's a gut check. It really is. It's a challenge that forces you to look in the mirror and be brutally honest with yourself. Can you handle this? Are you really, truly cut out for the ups and downs of long-term investing? Because, and I promise you this, another crash is coming. It's not an if, it's a when. There will be another panic. There will be another time when your portfolio is down big. And when that day comes, your entire future could hinge on one simple thing. Do you see it as a threat that could destroy you or an opportunity that could make you?
All right, let's jump right in. Now, if you're a business leader, you probably see risk as a huge cost center, right? Something to manage, minimize. But what if you could just flip that whole idea on its head? Today, we're going to break down how you can actually turn risk from a liability into this incredible engine for profit, for customer loyalty, and for some serious strategic control. This is not about playing defense. This is about getting way ahead of the game. And look, this quote from a recent Marsh report, it really says it all. This isn't just some friendly advice. It is a flat-out warning. In the market we're in today, if you're standing still, you are falling behind. This whole concept is no longer some niche idea for a few massive companies. It's becoming an absolute strategic necessity. So what's the big rush? Well, it's because that old traditional way of just buying insurance off the shelf, it's just not the safe bet anymore. The source material is really clear on this. Those old models can literally hold your business back, putting a drag on your efficiency and weakening that connection you have with your customers. Which kind of forces you to ask a pretty tough question about your own business. You have to look in the mirror and say, is our insurance setup right now a strategic asset, something that's actually helping us win? Or is it just a check we write every year, a sunk cost we have zero control over, basically a liability? Okay, but there is a really smart, forward-thinking solution here, and it's all about combining two super powerful concepts, affinity programs and captive insurance. See, when you put these two together, you can turn that liability into a genuine strategic asset. So let's quickly break down what we're actually talking about. So first up, an affinity program. You've seen these everywhere. Think about a big electronics retailer offering you that optional gadget insurance when you're at the checkout, or maybe a professional group that offers its members a special kind of liability policy. The whole point isn't just to sell another product, it's about adding value and making that bond with a brand even stronger. And then you've got the second piece of this puzzle, a captive. Now, the textbook definition says it's a subsidiary company you create to insure your own risks. But, okay, let's just cut through all the jargon. What on earth does that actually mean in plain English? It's really this simple. You are creating your own private insurance company, one that's built from the ground up specifically for your business and for your customers. And that right there is the fundamental shift in thinking. You're moving from just buying insurance to actually owning and controlling your own risk. And when you put them side by side, the difference is, well, it's night and day. With traditional insurance, you have very little control. You're kind of at the mercy of whatever the market is doing, and you're just paying to hand off your risk. But with a captive, you get direct control, you can unlock incredible cost efficiencies, and the entire focus shifts to your customer. It's a whole different ballgame. Okay, so let's get to the good part, the payoff. How does this strategy actually create real, tangible value for your business? What are the bottom line benefits you can actually expect to see? First, and this one's a big one, you reduce costs. It's pretty straightforward. Since you are now the insurance company, any of those underwriting profits that would normally go into a big carrier's pocket, yeah, they now stay with you. Plus, you get direct control over the claims process, which can have a massive impact on your bottom line. Second, you can seriously boost customer loyalty. Think about it. Instead of some generic one-size-fits-all policy from a giant insurer, you can design products that are perfectly tailored to what your customers actually need and want. That kind of focus on the customer, that's how you build a much stronger, much more resilient relationship. And finally, you enhance control. And this is huge. You are no longer just a passenger, subject to the whims of the traditional insurance market and its crazy cycles. You're in the driver's seat. You gain direct influence over your risk strategy, which leads to real long-term stability and makes sure that your risk management is perfectly aligned with your bigger business goals. So the main takeaway here is that all these benefits, they feed into each other. You improve your operations, you build a truly customer-first approach, you get long-term stability, and you turn risk management from a headache into a tool that actually helps you achieve your core mission. Okay, so that's the what and the why. Pretty compelling case, isn't it? But the million-dollar question is always, how do you actually do it? Well, the good news is the source material lays out a very clear, actionable path forward. It really all boils down to 3 key steps. First, you have to understand, learn the mechanics, see how it's all structured. Second, you identify. You've got to do that internal homework to see exactly where the benefits are for your unique organization. And third, you navigate. You follow the practical steps to actually get the program up and running. This is a deliberate strategic journey, for sure, not an overnight switch. Honestly, the message from the source couldn't be any clearer. The entire business landscape is shifting, and the leaders who act proactively are the ones who are going to win. Taking action on this now isn't just about a quick win. It is about fundamentally positioning your organization for sustainable, long-term success. So we'll just leave you with this final thought to chew on. We're all trained to think of risk as this negative thing, right? Something to avoid, something to offload as quickly as possible. But what if that's all wrong? What if your organization's greatest untapped asset has been hiding in plain sight this whole time in the very risk you're currently paying someone else a lot of money to manage for you? Today, we're diving into one of the most recognized brands on the entire planet, Coca-Cola. But we're not just talking about the drink itself. We're breaking down the investment case for its stock, ticker symbol KO. So let's get right into it. Brings us to the central puzzle, really. I mean, everybody knows Coca-Cola. It's this massive global icon. And yet its stock has been, kind of sluggish lately. So what's actually going on here? Why is there this disconnect between its incredible brand power and how its stock is performing? And this chart really paints the picture. If you look at the last 6 months, Coca-Cola's stock has definitely been lagging behind the broader S&P 500. This is exactly what we're talking about, and it's the reason why analysts are taking a much closer look. So here's how we're going to break it all down. First, we'll dig right into that lagging stock performance. Then we're going to explore why Coke is considered a business that's built for uncertain times. After that, we'll talk about its incredible status as a dividend king, what Wall Street's bull case looks like, and finally, we'll pull it all together to see the complete picture. All right, first up, Coke's lagging stock. And this is really a tale of 2 halves. You see, to be totally clear, it wasn't a bad story for the entire year. Coca-Cola actually got off to a really strong start. It's this more recent underperformance just over the last 6 months that has created this puzzle, and maybe a new opportunity for investors. So, if the stock is lagging, you might be wondering why analysts are so optimistic. Well, it all starts with the defensive pillars of the business, which brings us to our second section, built for uncertainty. Now, to really get Coke's strength, you have to understand this idea of a recession-proof stock. This is basically a company whose products people just keep buying, almost on autopilot, even when they're cutting back their spending everywhere else during tough economic times. Think about it like this. When a recession hits, what do people cut back on? It's the wants, the big vacations, the fancy dinners out. But the habits, like grabbing your favorite soda or drink every day, that demand stays remarkably steady. And Coca-Cola, it lives firmly in that habits column. And in a chaotic market, that kind of consistency becomes a superpower. While other companies might give you these wild swings in their earnings reports, Coca-Cola's performance is, it's predictable. And in times of uncertainty, the market absolutely loves a business that doesn't deliver nasty surprises. But a recession isn't the only threat out there, right? What about something like international tariffs, which can cause total chaos for global companies? Well, it turns out Coca-Cola has this really fascinating structural advantage that helps protect it from that exact risk. And here is the secret sauce. Even though it's a massive global brand, Coke isn't really shipping finished bottles of soda all around the world. It actually has this huge localized manufacturing system. The products are mostly made right in the regions where they're sold, which means the company gets to sidestep a lot of the tariffs that come with shipping stuff across borders. Pretty smart. That incredible stability leads us right to the third pillar of this whole investment case, Coca-Cola's legendary status as a dividend king. Just look at that number. 63. For 63 years in a row, through recessions, market crashes, global crises, you name it, Coca-Cola has increased the dividend it pays out to its shareholders. I mean, that is an absolutely staggering track record of consistency and financial strength. And that consistency, it puts Coca-Cola in a very, very exclusive club. A dividend king is a company that has raised its dividend for at least half a century. It's a title that's really reserved for the most durable and shareholder-friendly businesses in the world, and Coke is one of its most famous members. So what does this actually mean for investors today? Well, Coca-Cola's forward dividend yield is 3.1%. Now compare that to the S&P 500 average, which is just 1.2%. For anyone who's looking to get some income from their portfolio, that is a huge difference. Okay, so we've covered the defensive strengths. Now, let's get to Section 4. Wall Street's bull case and the potential upside from here. At the end of the day, here's what analysts are saying. Despite its recession resistance, its protection from tariffs, and its amazing dividend history, the market just isn't valuing Coca-Cola correctly right now. They see a gap between its current price and what it's truly worth. And they've actually put a number on it. If you look at the consensus price target from Wall Street analysts, they're seeing a potential upside of about 15% from where the stock is trading right now. So here's how they get to that number. The source material shows the current price hovering around $68.45, but the average analyst target is way up there at $77.49. And that gap, right there, is where that potential 15% return comes from. So let's bring it all home and put all the pieces together in our final section, the complete picture. So let's just quickly run through the core arguments one more time. You've got a business with recession-resistant demand, driven by simple consumer habits. It's structurally insulated from tariffs because of its local production. It holds this elite dividend king status with a really attractive yield. And on top of all of that, Wall Street sees a potential 15% upside. Which leaves us with this one big final thought. The whole Coca-Cola story is built on predictability, durability, and consistency. And in a market that feels more unpredictable than ever, you really have to ask yourself, is that kind of consistency the ultimate competitive advantage for an investor?